All right, I think we are live. And we're just going to give it a minute here and see if people join. Last count, we had about 60 registrants, so that's great. But I know with the storm and everything, a lot of people are probably going to be looking for the recording. So
yeah, Tim was like, "Are y'all going to reschedule? Because all of Maria's investors are in Florida."
Yep.
I was like, "No, I think we're rolling with it."
Yeah, well, the thing is that it's really hard to reach everybody. You know, I could send an email, but they may or may not see that. So we're just gonna roll with it and see what happens here. So we'll give it another minute or so to let people join in. And if people are all out of power already and they need to watch it on the recording, they can watch it on the recording. All right. So I don't know if you can see that, but 3 people have joined so far. And it shows.
Does it ever tell you who's on?
No, I don't think it does. It's also streaming live on Facebook. So no, it just says that they're coming in through various channels. So they're coming in through StreamYard and Eventbrite, and yeah, that's where they're coming right now. So for those of you watching, we're just going to give it another minute here for people to join. We suspect most of my investors are in Florida, where there's a storm coming down on us right now. And so a lot of them are probably going to be watching this on the recording. And as a matter of fact, we have planned for a contingency because I'm afraid my power is about to go as well. So Jennifer and I actually went ahead and pre-recorded this, but we'll still be here to monitor questions in the chat. But we're going to actually play the recording. Jennifer's going to play it on her side because she's in Texas. So she's less likely to lose power. And but again, we are here. It is a live thing. She's just going to play the recording just to make sure that if I lose power, we can't finish the webinar. Hate to do that to you guys. So I think with that, Jennifer, do you want to go ahead and I'll unshare this and or stop sharing, and I'll let you share the recording, and we'll go ahead and kick it off, and then people can post their comments in the comments section, and sure. We'll take it from there.
Sounds good.
All right. Hello, everybody. Thank you so much for joining us today. Today, we're going to talk about a really exciting subject, how to pay zero taxes investing in real estate. So you get to spend the next hour, give or take, with me and Jennifer. We'll have 15 minutes at the end for questions. So please hold all your questions to the end if you don't mind, and we'll be putting them in the chat. So at the end, we'll come off screen and we'll be answering those questions in the chat. So please hold it until then. So with that being said, Jennifer, you want to introduce yourself?
Sure. Yeah, my name is Jennifer Semien. I'm a CPA with 20 years of experience from Texas. I started my career in audit, not tax. And I actually thought I was pretty cool as an auditor and not necessarily a nerdy tax accountant. But had I known I would end up where I am today, I probably would. Having chosen tax probably would have been a smarter choice for me. But of course, hindsight is 2020, and audit did give me the base I needed for a pretty successful career in accounting. I decided when I got laid off in December 2020, decided to pursue entrepreneurship and real estate investing full time. So I am a fund manager. I help people invest in real estate passively, and I also help them with advanced tax strategies specifically related to business ownership and real estate. And I'm happy to be presenting this topic to you guys today.
Awesome. And I'm Maria Zondervan. So I'm a capital allocator, which means I help people invest passively in real estate, generally large apartment complexes or things of that nature. But you do become a full owner in the properties when you invest that way. So you do get to take advantage of all these same tax strategies. And I sort of ended up this way, also not on on purpose, kind of like Jennifer. I had a different career, but then I found out that I could do really well in this space. When I had a special needs child, I really needed to start increasing my income, and found out that tax savings was one of the ways that I could migrate from W-2 into this field. So we'll talk more. Basically, I invest in a ton of properties passively, and I allow others to invest alongside me, and then I help them save on taxes. So, all right, we're going to kick it off here. So here's the disclaimer, of course, it's required on every webinar, I think, but basically you need to get your own tax advice. You need to work with your own CPA, your own tax strategist, because everybody's tax situation is different. It's going to vary from person to person, and so you need to consult with them. All right. Jennifer, you want to kick us off with depreciation?
Yes. So, yeah, let's talk about depreciation. Depreciation is the king of all tax deductions, especially for real estate investors. So, just a little background or technical definition of depreciation. It's actually an accounting method where the cost of an asset is deducted over the asset's useful life. And this is to help to account for wear and tear, deterioration, and obsolescence. And in real estate, this means that you can deduct a portion of your property's cost each year from your taxable income. The most common method of depreciation is straight line. And in real estate, that means that you can depreciate residential properties for 27.5 years and commercial properties for 39 years. And so the calculation is pretty simple. You basically just divide the cost of the asset or the cost of the property, excluding its land value, divide that by its useful life of 27.5 or 39 years. So that is what you would call straight line depreciation. Then there's something called accelerated depreciation. Accelerated depreciation, that's the most talked about term among real estate investors is bonus depreciation. And so bonus depreciation allows for the immediate expensing of a percentage of the cost of a qualifying property in the year that it's actually purchased or acquired. So bonus depreciation was 100% a couple of years ago. So that started with assets that were placed in service after September 2017 and before January 1, 2023, or up until December 31, 2022. So that bonus depreciation actually reduced down to 80% for 2023 and is currently sitting at 60% for 2024. And that bonus depreciation is going to reduce by another 20% each year until it completely phases out on December 31, 2026.
Very good. All right. So I'm going to talk a little bit about cost segregation. This is one of those things that kind of helps lead to that bonus depreciation if you're in the real estate world. So bonus depreciation can be applied in other parts of the tax code as well. But when it comes to real estate, cost segregation is sort of the gateway to get you there. So as Jennifer was saying, with residential property, for example, it takes 27 and a half years to fully depreciate that property. Well, you can make the argument. So basically, that's the IRS saying in 27 and a half years, this property is worthless. Okay, we all know that's not true. When we look at properties 27 and a half years ago, what they were going for, and we look at what they are now, obviously they're a lot more valuable. But that's why this depreciation is really just a paper loss, but it can be a big loss. And that's why we like to take it on our taxes. But what we can do is we can make an argument with the IRS that says, not everything on this property is going to last 27 and a half years. The roof, for example, might only last 15 years. So then you can put that sort of in this separate category of things that are going to depreciate in 15 years. So instead of depreciating that roof over 27 and a half years, you're now depreciating it over 15 years. So you take the value of that roof and you divide it by 15, and that's how much you can take per year when you've done these cost segregation studies. So cost segregation study basically means you have an engineering team that goes in and they look at everything in the property, everything from the doorknobs to the appliances, the flooring, everything in that property. And they put it in categories: 5-year buckets, 7-year buckets, 15-year buckets, or the stuff that's going to stay with the 27.5 years, right? And then you can accelerate the depreciation on those. So basically front loads all of that depreciation, gives you much bigger write-off early on in the ownership of this property. And with that bonus depreciation, you can then take a lot of that stuff that's been front end loaded and take, like Jennifer said, right now, 60% of that all in that first year. So very powerful technique to write off a whole lot of taxes right off the bat here. Jennifer, over to you.
Okay, so it's important that real estate investors understand the passive activity loss rules. So these passive activity loss rules were first established in 1986 under the Tax Reform Act, and they play a crucial role in real estate investing. First thing to understand is, what is a passive activity? So a passive activity, it's any trade or business where you don't materially participate. Most rental real estate activities fall into this category, regardless of how much you're involved, because the IRS just happens to classify rental income as a passive activity. And so, unless you qualify as a real estate professional, we'll touch on that later, it would be considered by the IRS as passive activity. So the income and the losses in your rental real estate business or portfolio. So the core purpose of the passive activity loss rules is to limit investors from using those losses that Maria mentioned that you can create using cost segregation and bonus depreciation. So it prevents investors from using those losses against passive activities to offset. The core purpose of the passive activity loss rules is to limit investors from using losses against passive activities to offset income from non-passive sources. So think like W-2 income, 1099 income. So basically your wages, your salaries, those type of active income sources. So then there are some exceptions to these rules. So like I mentioned earlier, if you qualify as a real estate professional, your rental activities aren't automatically considered passive. So this status allows you to use rental losses to offset non-passive income. And then there's also an exception for active participation in rental real estate. So if you're actively involved in management decisions, you might be eligible to deduct up to $25,000 of rental property losses against non-passive income. So the thing to know about this is that it starts to phase out as your income increases. So you would be able to deduct, if you had rental property that you had active participation in, you would be able to deduct up to $25,000. And then again, the phase out starts at about $100,000 of modified adjusted gross income, and then completely phases out at $150,000. So when it comes to deducting these passive activity losses, you just have to remember two key points. One, passive losses can only offset passive income, and then any excess losses are carried forward to future years. So whenever you have excessive passive losses that you couldn't take in a current year because either they exceeded the 25,000, or if you didn't qualify because your income was too high, any of those passive losses that you didn't get to use will be able to be carried forward and used in the future against passive income. However, when you do dispose of a passive activity in a taxable transaction, you can use those suspended passive losses to offset any type of income. So for instance, if you're invested in a property, the year that that property has an exit activity or is sold, you would basically take all of those accumulated losses and write them off or use them at that
Okay. So I think your microphone cut out a little bit there, but I just want to be clear with what you said there. So it's not a use it or lose it type of situation. If you're not using it, you can use it in future years, and then when the property sells, anything you have left over, you can utilize it at that point.
Correct. Absolutely.
Okay. So it reduces your capital gains. All right, great. Yeah, your mic just cut out a little bit. I want to make sure that was clear. All right. Anything further on passive losses? Passive activity?
That would be it. Yep.
All right. Then, yeah.
Okay, so there are a few strategies that you can use to offset your W-2 income. We've kind of alluded to one, but we will touch on that and others in just a second. And the good thing about this is this next strategy that we're getting ready to talk about, this is something that you can use to implement and save taxes on as early as this year. So this strategy, this first strategy is called the short-term rental loophole. And it can get you to zero taxes, depending on the amount of the property or investment that you make. But basically what it is a short-term rental is a property that's rented out for an average of 7 days or less per tenant. So if you think about the properties that are listed on Airbnb or other vacation rental websites where you go and stay for a weekend or most of the times a week or less, those are typically short-term rentals. And so short-term rentals, they don't fall under the same passive activity loss rules that we discussed earlier, because those rules essentially apply to long-term rentals. The key to unlocking this loophole is material participation. So that's a defined term. So to benefit, you must be actively involved in managing and operating the actual rental property. And this generally means that you're handling day-to-day activities like bookings, guest interactions, cleaning, maintenance, and other management tasks. So there are several tests, 7 to be exact, but the most common are the 500-hour test, the 100-hour test, and the substantially all participation test. We actually have a slide on material participation later, and Maria's going to go into it as well. So I won't steal her thunder, and I'll just hand it over to her to talk about that. But before I do want to let you know there's 2 main benefits to the short-term rental loophole. First, if your short-term rental activity is considered non-passive, you can use the losses from that activity to directly offset your active income. So this is where you would be able to take losses. You acquired a property, you did a cost segregation study, you used bonus depreciation and created paper losses. You would be able to use those losses to offset your W-2 income, your self-employment income, and any other active business income that you might have. So again, by combining this strategy with cost segregation and bonus depreciation, you're actually accelerating that depreciation and creating substantial tax deductions that can reduce your taxable income. And you don't need to be a real estate professional to take advantage of this.
Yeah, I'd love that, because that line between active income and passive income and not being able to cross that all the time is so difficult. But here, like it says, it's a loophole, right? You can make that active income. Very good. All right, let's see if we can advance our slides here. So let's talk about real estate professional status, because this is my favorite thing on earth. This is what allowed me to essentially leave my job that I had had for 26 years. So as I mentioned, I had a special needs child. My son has autism. And at some point I started, as he was approaching adulthood, worrying about, how's he going to survive for the rest of his life if he can't have an income of his own and something happens to me. So I need to really increase my wealth. So at the time I had a job that was paying okay, but it wasn't going to allow us to grow our wealth as fast as we wanted to. So I've been doing real estate on the side, but I hadn't done it full time. I wanted to go into it full time, but I was afraid to make that leap. I was afraid to give up that W-2 income. Then someone came along and told me about real estate professional status and what that could do for us. So the other part of our income was that we owned a couple of massage MB clinics, and my husband was running those while I was doing my job. But that meant we were being taxed to death. I mean, when you're a small business owner, you just get hit with so many taxes. And we didn't have much ways to offset that except for the little bit of depreciation we had on our rental properties, but I wanted to scale that and make it bigger. And we could only use that depreciation for the most part to offset the rental income, not the rest of our income. And so someone said, well, you know, if you become a real estate professional, if you have that status, then that passive income from real estate becomes active income. Essentially, that's how it's treated by the IRS. And so now the losses from that, these paper losses, this paper depreciation that Jennifer's been telling us about, can now offset that active income from the massage MBs, and that could eliminate a bunch of your taxes. And so when I factored in the larger scale investments I'd be doing passively now that I was leaving my job, so these larger investments in apartment complexes and such, and I started doing the math, I figured out that I was working for free. And it just killed me. I was working for free. I'd basically been doing that for a couple of years because the investments we were making had been using this bonus depreciation, the cost segregation, all those things had been implemented, and we were getting all this depreciation, but we weren't able to utilize a lot of it because it wasn't active income, it was passive income. So as soon as I left my job and could claim real estate professional status, I was now able to utilize that full depreciation and write off enough taxes to take the place of my entire paycheck. So for 2 full years, I paid no taxes, my husband and I. So there's a law here that if you're filing taxes jointly with your spouse, this can apply across your entire tax return. So you don't both have to have this status. So I was able to write off the money he was making at Massage Envy with the passive losses on the real estate side. So that's basically how this works. So for 2 years, I legally paid 0 taxes. So completely legal, guys. But anyway, so there are some qualifications. Obviously, it's not enough just to go leave your job and have a rental property, right? So you have to put in the work. And in my case, I went full time into this. So the first qualifying criteria that you see here is that you spend over 750 hours in real property trade or businesses, okay? And that more than half of your personal services are performed in all trades or business during that tax year or in real estate. And you do have to have real property or business within that. So it can be development, redevelopment, construction, renting out, operations, all the things you see here on this middle part of the slide. So it can be any of those things. And then it has to be material participation. So Jennifer already talked about this a little bit, but there's this 500 hour test, substantial participation, 100-hour test. So we'll get into that a little bit more, but basically you have to actually work in it and you have to have some ownership. So for example, if you were being paid as a W-2 employee as a real estate agent and you showed other people's houses, you didn't own them yourself, and you didn't own the brokerage or have any ownership in that brokerage, even though you're working in real estate, it's not going to qualify you, right? But if you own 5% or more of that brokerage firm, now you're qualified. If you are showing properties that are your own, you're leasing out your own properties, you're doing some property management, those kind of things can qualify you. So you do need to dig into it a little bit, but if you qualify, this is very powerful, especially when you combine it with that depreciation, cost segregation, bonus depreciation, all those things that we've talked about. Jennifer, did I miss anything on that?
I think you covered it.
Okay, great.
I don't think you can say it how powerful it is, but yes, as long as we continue to stress that.
Right. So as we mentioned, the IRS has a lot of tests. They have 7 different tests for this material participation part of it. So they have 7 tests, but you do not have to qualify for all of these. You just have to qualify for one of them. And not all of these really pertain to real estate. Some of these are material participation in other businesses. So this is their overall material participation list. So number 1, number 2, 3, and 7 are the ones that would be most applicable to real estate. And rather than read you everything on these slides here, we're actually going to send out the slides to everybody that registered for the webinar. So you'll have a copy of this, but you should also talk to your CPA or your tax strategist about these. But we talked about the 500 hours, right? We talked about more than 100 hours of activity in there, all these things. And substantial participation, meaning you're not just turning this over to a property manager to do this for you. Regular, continuous, substantial, they're looking at, are you really doing this all the time? Have you done it in the past? Are you looking to do it in the future? Are you doing it now? So all of those things are going to count. So that's the brief overview here. Yeah. Jennifer?
And the great thing is that you only have to meet one of these tests.
Correct. Yes. Only one. So, all right. Jennifer?
All right. So some of you might already be landlords and investors, and you might be either planning to sell a property someday, or, part of the business plan of what you're invested in, maybe planning to sell someday. So that is where capital gains taxes come in. And if the thought of taxes, like taking a big chunk of your profit, that's causing you to lose sleep at night, then we're here to help you, because we're going to share a couple of strategies, or 3 strategies that can help you with offset these capital gains and to defer them.
Yeah. And we all know capital gains is already lower than your regular income taxes. So you're already lower, but we're going to make them even lower, right?
That's right. Yeah, because they are taxed at rates that are typically less than your ordinary income, but we're on a mission. Don't think I said this earlier, but we're on a mission to pay as little taxes as legally possible. Okay, so the first thing we want to look at to offset and defer capital gains are opportunity zone investments. So opportunity zone investments are, opportunity zones rather, are economically distressed communities where new investments under certain conditions may be eligible for preferential tax treatment. So opportunity zones were created under the Tax and Jobs Cut Act of 2017. And the purpose of it was to spur economic development and job creation in low income areas. So to invest in the opportunity zones, you must place your capital gains into a qualified opportunity fund. And the tax benefits of these opportunity zone investments are pretty substantial. First, when you invest your capital gains in a qualified opportunity fund, you can defer the tax on those gains until December 31, 2026. And if you hold the qualified opportunity fund investment, previously, if you were to hold the qualified opportunity fund investment for at least 5 years or at least 7 years, you could get your deferred capital gains tax reduced by 10 or 15%. So the thing about this, though, is that because it's set to expire of December 31, 2026, these 5 and 7 year hold periods are also set to expire unless Congress acts to renew them in some form or fashion. So main point of this is that you can defer capital gains until December 31, 2026, and then you will need to either hope for an extension or figure out like a different strategy or apply a different strategy to offset those gains. But the ongoing benefit of a qualified opportunity fund investment is if you keep it invested for at least 10 years, any appreciation in that investment is going to be completely exempt from capital gains taxes. So said another way, basically all new gains on that investment are going to be tax-free. So the opportunity zone investments, they offer a unique combination of tax benefits and social impact. And it's a powerful tool for building wealth while contributing to community development. So like I mentioned, as of now, the capital gains benefits are set to expire on December 31, 2026, but the opportunity for the tax-free growth does not actually expire.
Yeah, and we should also mention like bonus depreciation, it has come and gone over the years, right? And it's been at all different levels. So it's very possible that this will come back too. Congress uses all these methods to spur the economy all the time. So, I would not be surprised if this comes back and is extended beyond that date. But like you said, tax-free growth, I mean, that's amazing. We all love that anyway. So very good. Very good. All right, 1031 exchange. So this is another one of my favorite things, but it can be a little complicated. I have gone through this myself, where I came down to 2 days of failing to do this. So, but it worked out. So here's basically what this means. Generally speaking, when you sell a property, you have capital gains tax. That's what Jennifer was saying. We're trying to help you avoid having to pay, right? So even though it's at a lower rate than ordinary income tax, we want to eliminate it or reduce it or defer it as long as we can. So the 1031 exchange rule says this: when you sell one property, if you're going to be buying a new property, you can defer the taxes from the old property into the new one. You're basically exchanging one property for another. So instead of selling those, paying the taxes, and then having less money to invest in the new property, you can take the full amount of what those gains and not pay the taxes, defer the taxes into the new one, and then you have more money to put down on that new property that you're buying. So it's a very powerful strategy for when you want to level up. So maybe you started with a single family home and then you own it for a while, it appreciates in value and your loan gets paid down. And then you sell that and you go buy a quadplex, for example, right? And then later you buy an apartment complex and so on and so forth. So you can really level up here. But there are some qualifications that you have to meet. So first of all, you have to have a qualified intermediary. So that's somebody who makes sure you're following all the rules, that you're sticking with the timelines, that you're identifying your property on time that you're going to exchange into. And they're the only people or the only entity really that can touch the funds. If the property sells and you take possession of those funds before the next property is purchased, then you have ruined your 1031 exchange. It is now null and void. You can never touch the funds. It has to go through this qualified intermediary. So when it sells, it goes into escrow with them, and then it gets deployed into the next property. If you do want to take out some money, say you want to realize some of that capital gains, you can do that. It's called a boot, and you'll pay taxes on that portion of it, but it still doesn't preclude you from pushing most of it into another property. But you do have a very short time window to identify what the property you're going to exchange into. This is the IRS making sure that you don't just do this, wait for years and years and years to find the best deal, wait for everything to appreciate, all that kind of stuff. So they say you have 45 days. 45 days from the time you sell the first property to tell them to identify what property you're going to buy next. Now you can identify up to, I believe it's 3 properties, and you only have to close on one of those. So if you're kind of in between or you're working on contracts or whatever, you could put down 3 properties, and you could actually exchange into multiple properties if you want to, but you got to close on at least one of those properties. But then you have 180 days to actually close on it. So you have a little more time to get it all finalized, but you do have to identify within those 45 days. And I personally came down to 43 days. I was really sweating it. And you don't want to get into a bad deal just because you're in a hurry. So so the time clock is ticking. You should really have a plan when you're doing this, and definitely talk to a qualified intermediary in advance. So the taxes are deferred, they're not forgiven, but you can theoretically kick the can down the road essentially forever. Because if you keep doing this process and you never sell and just totally cash out, those taxes just keep getting deferred. And upon your passing, when your heirs get the property, the taxes are essentially wiped out. So the tax basis resets to the day that those property transfers to your heirs. So it is a way to leave somebody very valuable piece of property at that point without that tax burden. That tax burden goes away. So it's extremely, extremely powerful from that perspective. Yeah, anything I missed?
Well, I think now is a good time to bring up depreciation recapture. So depreciation recapture is kind of unavoidable, which basically is a way for the IRS to tax you on depreciation that was taken in advance. It's not necessarily a bad thing or anything to be afraid of, and you shouldn't avoid strategies or taking depreciation because of depreciation recapture. But basically, what it is depreciation recapture that is in excess of what the property would have normally depreciated over time. Any accelerated amount that's taken in excess is taxed at your ordinary income rate up to a maximum of 25%. And this happens when the property is sold or exited. But if you participate in a 1031 exchange, it can also defer that depreciation recapture.
Yeah, very valuable. So anytime we defer, it's beneficial, even if there is a tax later, because that's years and years and years of time when you have access to that money and could be reinvesting it and making money with it elsewhere, right? So deferring taxes is always good, even if, say, the same amount was due later. But of course, we're working to reduce the amount even later. And later dollars are worth less than they are today, right? Inflation is making sure of that. So a dollar today will not be worth the same as it is 20 years from now. So anytime we defer, we are saving money.
Getting the opportunity to invest.
Exactly. All right.
Okay, so if for some reason you don't qualify or make the deadline or don't want to go through the hassles of a formal 1031 exchange, there's something that I refer to as the lazy 1031 exchange. This is not a technical IRS term, so you won't find this on the IRS website as an approved strategy. But basically, what it is it has some similar benefits of a normal typical 1031 exchange, but it's a lot simpler process. So instead of deferring capital gains through a traditional 1031 exchange, you can still offset those gains by investing in new properties that will generate substantial paper losses. So again, these losses are primarily created through cost segregation and bonus depreciation. So here's how it would work. So first, you would sell your appreciated investment property, realizing a capital gain upon sale. And instead of exchanging into a like-kind property via traditional 1031 exchange, you invest those proceeds into one or more new properties that qualify or have plans to do cost segregation and bonus depreciation. Then, you or the operator syndicator, could perform a cost segregation study on the new properties. And this is going to, again, reclassify components of that property into faster useful life buckets, which is essentially accelerating depreciation. And then you apply bonus depreciation on top of that to create those substantial paper losses in the first year of ownership. So finally, when you're able to use these paper losses that are generated from the cost segregation and the bonus depreciation to offset the capital gains from the sale of your original property. So the key benefit of this strategy is that it allows you to defer your tax liability similar to a 1031 exchange with a lot more flexibility in both the property selection. So, for example, let's say you sell an investment property and you realize, let's say, $150,000 capital gain. Instead of doing a traditional 1031 exchange, let's say you invest 300,000, or you have throughout the year invested 300,000 in multifamily syndications, and that are planning or taking advantage of cost segregation and bonus depreciation strategies. So just imagine that those investments are creating paper losses. If we just use a 50% mark, if we say, okay, 300,000 cost segregation can create, and bonus depreciation can create paper losses in the first year totaling 150,000, you would essentially be able to use that total 150,000 to offset that 150,000.
Got it. I think, yes.
Yes, yes. The numbers are similar, but yes, the 150, just imagine the 150 capital gain and then 350% of 300, 150 paper loss offset to zero.
There you go. There you go. That's awesome. Yeah, and we should mention that all of these strategies that we've been talking about, well, not all of them, not like the short-term rental loophole, but pretty much all of these can be done either as a passive investor or as an active investor. And if you don't know the difference there, basically, if you are an active investor, it means you went out and you sourced that property, you got it under contract, and you negotiated the terms, you bought it with your own money, you're doing all the work, all of that kind of stuff. That's an active investor. It's what most people think about when they're going and buying like single family homes as rental properties and that kind of stuff. Passive investor is what Jennifer was talking about with real estate syndications. So all a syndication is when a group of investors get together and they pool their money to go buy something bigger than they would be able to buy on their own, or in most cases won't be able to buy on their own. So like if I want to go buy a 100-unit apartment complex, I don't have the money to go do that on myself. But me, Jennifer, and 50 of our closest friends, we could go do that, right? Your biggest partner is actually the bank. They usually bring like 70 to 80% of that purchase price. So you're just coming up with the down payment, but you and a collection of other people can do that. And then there's a general partnership that manages all that. And they do all that. Now they're usually putting money in there too, but the rest of the partners who aren't doing the management, they're called limited partners or passive investors. So they're still owners. They get all these tax benefits, but they don't have to do the day-to-day work, right? Now, you have to be careful if you're doing that professional real estate status. If all you're doing is passive investing and you're not participating in any of that management and you don't have your other stuff, that's not going to qualify. So again, you have to talk to your tax consultant on this. But when it comes to this lazy 1031 exchange, you can absolutely do that as a passive investor. 1031 exchanges, even though it's one property for another, you can actually do that into syndications as well. It's a little more complicated. There's something called tenant in common that you have to enact. Your exchange usually has to be of a certain value, but it can certainly be done. There's also Delaware statutory trust that you can go into with it, just about any amount in a 1031 exchange. The bottom line is you'll need to get some counseling to help you get through this, but most of these things can be done either actively or passively. So don't think you have to always go out and buy and manage all these properties, especially if you're a busy business owner, business professional. You just, you have that 40-hour plus job already. You might not want to do all this on your own. So either Jennifer or I can help you find passive investments if that's more your style. But these can work either way, active or passive. So hopefully we're bringing value to you, regardless of which side of that fence, or both, if you're on both sides of that fence. Yeah. So, all right. Let's see. Okay. So yeah, basically, we've brought you some value. This is our contact information. If you would like to reach out to either of us about more information, either with tax strategies. So Jennifer does some tax consulting. I'll let her tell you about that in a minute, or about investing passively. Like I said, I'm a capital allocator. I can help you with that. And Jennifer is a fund manager, so she can help you with that. Jennifer, what kind of tax strategy stuff can you do for people individually?
Yeah, so I work with business owners and investors to help them perform an evaluation of their current tax situation and their future plans, and to do an assessment of the type of tax strategies that would be available to them. This is, I would say, I mean, it's a pretty simple exercise, right? Because basically, I'm looking at your past tax return, and I'm talking to you about what you have. What is your current situation? What are you looking to achieve? What do you see happening for yourself in the next 2, 3, 5 years? And then we start looking down the road and picking the different strategies that you can start to implement, either today or tomorrow or next year. Now's a good time. I think we're all kind of getting past this extension deadline and probably being reminded of, how bad how much it hurt to pay these taxes. So there's still a little bit of time left to implement some strategies for this year. And so, yeah, I'm happy to work one-on-one with people, just to, even if it's just an assessment to see where you stand. And then, I'm also available for ongoing implementation and basically hand holding to help you get these strategies implemented, throughout the year. So.
Yeah. December 1st is not the time you want to start implementing tax saving strategies. That should be a January 1st and throughout the year type of thing. So I know I've reached out to Jennifer in the past when I've gotten into some unexpected high taxes, and she's really helped me out. So I highly recommend her. But I reach out to my CPA and tax strategists like Jennifer throughout the year to get a handle of it and see where I'm at and plan for that in advance. So it's super, super important. So, and on my side, I work with people who want to invest passively. I have funds, I do co-GPs and both long-term and short-term. And my whole thing is just helping you just figure out your strategy. A lot of people come to me and they said, I want to invest in real estate. I don't have the time to do it on my own, but I don't even know where to start, right? So we look at the differences between properties that cash flow a lot, properties that build a lot of equity. Some people have short-term needs. They need money right now. Other people have long-term needs. Maybe they're planning for a special needs child like I am. So there's all sorts of different investments within this realm. Some people like apartment complexes, like I really like that. Some people like new construction or self-storage or car washes. I mean, the choices really are endless. I would steer away from office buildings right now and a lot of the smaller retail spaces, but there's a lot of great ways to get into real estate, and I can just help you figure that out and show you what we have available. And there's no cost for my services or Jennifer's services when it comes to passive investing. So we work for the investor, but we are paid by the money we ourselves make on our investments in that deal and by the fund management fees. So no out-of-pocket cost for anybody there and great returns on your money. So if you're interested in that, please reach out to us. In the meanwhile, we're going to go ahead and take some questions. As I mentioned at the beginning of this presentation, we are going to do that offline in the chat. If you've been putting comments in the chat, we haven't been ignoring you. It's on purpose. We do them all at the end because we might very well answer some of those questions. And, we want to stick to the real estate tax questions here. If you have other personal tax questions, that's going to have to be a private consultation with Jennifer or your CPA or whatever. But if you have something related to what we have discussed here today, please pop them in the comments and we'll have about exactly 50 minutes. Yeah, this recording this has been going for about 44 minutes. We had 45 minutes for the presentation and 15 minutes for questions. So Jennifer, any additional last words before we start taking questions?
No, thank you for having me on and giving me a chance to share this information.
Wonderful, wonderful. All right. Well, we're going to go off screen here. But like I said, we will be answering those questions in the comments. If you're not seeing the comment section, check that you're not in full screen mode. In some browsers, if you're in full screen mode, you won't be able to see the comment section. So you may have to exit out of that in order to see those. All right. We will see you later. Thank you so much for your time today. And we will send out a recording of this, so you will get the recording. All right. Have a great day, everybody.
Thank you.
Okay. I do see one question on here. It is from Ken, and he says, I understand cost segregation, but what happens to cost segregation when bonus depreciation expires? I don't really understand how bonus depreciation works. So the bonus depreciation really just takes effect the very first year. So, those percentages are going down, but once you've taken the bonus depreciation, it really doesn't matter because all of that comes the first year versus the rest of the cost segregation. So if something was put into that 15-year bucket, like we talked about roofs doing that, that will continue to come, anything that you didn't take in that bonus depreciation. Because right now, it's 60% of those accelerated things that get taken in that first year. So the other 40% will then keep trickling in through those other years, depending on, again, if it's being if the cost segregation study put in the 5-year, 7-year, 15-year terms. I hope that makes sense. Jennifer, anything to add to that?
That's right. Yep. And it would just default back to the straight line depreciation over the useful life.
Yep.
Whatever is remaining.
After that. All right. So Ken, hopefully that answered your questions there. All right. So that's actually the only question I'm seeing right now. So either we did a really good job of explaining things or we put people to sleep. I'm not sure which, but we also know a lot of people weren't able to attend live because a lot of these, this webinar went out in Florida, or we've got a hurricane barreling down on us. So I'm actually really surprised that we did not lose power here. I was fully expecting that. You are welcome, Ken. Thank you so much. So, all right. Well, I guess that is it. If there are additional questions, again, you can reach out to me or Jennifer at any time, and we'll be happy to answer those, especially those of you who might be watching this on the recording. So you probably won't be getting your answers, today. So, all right. With that, thank you all so very much, and I wish you all a good night. Jennifer, any final words?
Thank you for tuning in, and have a good evening.
All right. Take care, everybody.